Hello, everybody.
Hello, everybody.
Welcome to Just the Tip Iceberg podcast. Just the tip of the iceberg, nothing more.
Nothing more than that, just the tip of the
Nothing more.
iceberg. Maybe some
Just,
polka dots on that iceberg, but that's about it.
yeah, speckled iceberg. Nice to hear everybody again, or if you guys can hear us. It's Greg in another new shirt.
Yeah, it looks like it was in my pocket most of the morning, and I just put it on, so it's a little wrinkled.
And I ran out of dress shirts. I have 3. I wore them all this week, and to t-shirts for the weekend. So,
Perfect. Look good.
yeah,
Looking
it's a
sharp.
comfy t-shirt.
All right.
Comfy t-shirt.
So today, what's the topic? We're going to talk about FHA or VA.
Conventional and FHA, and the costs between the two, why one's more affordable than the other, even though it might have a higher interest rate.
What does FHA stand for again?
Federal Housing Administration.
All right, so explain to me the difference between if I'm looking to get a mortgage and I don't have 20% down, I only have 5% down,
Or 3.
or 3%. Okay. So where does the cutoff between FHA and the word conventional? What percentage is that? How much down payment do I have to have
No.
to the ratio of my
It's not
purchase?
that.
Okay.
It's
all right.
not that at all.
Teach me, old
It's
wise
your
one.
qualifications for the loan. So you can get if you have it's about credit score really is one of the main determining factors. You can be a first time home buyer on a conventional loan and get as little as 3% down. But you've got to have everything else in line, and those are your credit score is going to have to be higher than it would have to be for an FHA loan, and your debt to income ratio, which is how much money you make monthly up against how many monthly obligations you have. That's going to give you a ratio. As long as that's below 43%, you're able to go conventional. But if that's higher, let's say you're at 48% on your debt to income ratio and your credit score is like a 600, you're going to want to go FHA. But because an FHA is more lenient, it's insured by the government, so there's less risk to the bank. So because you're not a prime borrower, you might have a credit issue or not have a crazy amount of money and your debt to income ratio is a little tight. That's what the FHA is for.
So where does this threshold of the credit score start and end? So if I want to put 3% down or 3.5% down, what is it? 3 or 3.5?
3% conventional, 3.5 is first time home buyer FHA, 5% standard conventional. That threshold is technically it's 580 is FHA, and then it's like 620 conventional. But
So what does that mean when you say conventional? What does that mean?
it means that it's not insured by the government. So,
So
you're
it's
only
not
gonna,
FHA.
the major cutoff is the debt to income, and the debt to income ratio is much different between the two. You can go up to 49, sometimes 50%, in an FHA loan, and you really want to stay below 43. Sometimes you can get to 44 or 45 on a conventional loan.
Gotcha.
Back
Okay.
end debt to income ratio that includes your new proposed housing payment, any mortgage insurances, property taxes, homeowners insurance, and all your monthly liabilities, credit cards, auto loans, things like that.
Awesome. Okay. So if I had good credit
Mm-hmm.
and I had a good job with low ratios, meaning I have very little debt with a lot of income, I could qualify for a 3% down payment, and I don't have to pay a premium for insurance.
You're gonna have to pay mortgage insurance up until one of the major differences is you're gonna have mortgage insurance on both. The difference between an FHA loan and a conventional loan is on an FHA loan, you're gonna have mortgage insurance for the whole time you have that loan. Whether you're below 80% or not, you're gonna have that mortgage insurance. On a conventional loan, you're only gonna have that mortgage insurance until you fall below 80% loan to value. When you hit 78%, it falls off automatically.
Okay.
At 80%, you can request an appraisal, and if you're below it, you can remove that monthly mortgage insurance.
Okay. So my next question is, if I qualify for a $200,000 mortgage and I do require FHA insurance, does my buying power of my $200,000 mortgage that I barely qualify for go down now because I need to qualify for the insurance in addition to my mortgage?
Yes, it does, but you're going to have both. So let's say that same $200,000 mortgage, you're trying to decide whether you want to go conventional or an FHA mortgage. You're going to have mortgage insurance on both. So if your debt to income ratio was 43, and when we add the mortgage insurance, it goes up to 46, you're going to have to go FHA because they're more lenient on that debt to income tolerance.
Gotcha. Okay.
So you'll be able to afford an FHA loan. Keep in mind, FHA and conventional both have county limits, federal county limits for the maximum that loan amount can be in a specific state, county. So conventional limits are typically higher than the FHA limits. and obviously in places like California or where there's a high cost of living, each county you can have conventional limits up to 726,000, to where in some states that limit might be 484,000.
Okay, so say I put my 3% down, I get an FHA loan, and then 3 years later I'm doing really well, and the interest rates change in the market, and I want to be able to refinance my current FHA loan into a lower interest rate, but now I have a high credit score and better income, so my or my risk level goes down. Can I get a new mortgage without FHA, and so I don't have to pay that premium for the rest of the entirety of that particular mortgage?
100%. It's encouraged to do that. So if you refinance out of an FHA loan into a conventional loan, your loan to value is below 80%. You're going to be able to omit that mortgage insurance. You're going to save a few $100 a month.
Perfect.
Right away.
Awesome.
There.
Okay, so paying it down on a regular basis in addition to my principal and interest payment would be beneficial in the long run to be able to do that if rates do go down. If it's
most of the interest on a mortgage is accrued in the first 10 years. So there is a huge benefit to making anything and above. And when people talk about prepayment penalties or no prepayment penalties, that's exactly what they mean. You're able to pay, just like a credit card, above and beyond the minimum payment, the principal and interest payment that's due. Anything above and beyond that goes straight to principal. So you're not going to be paying interest on that. You're literally just reducing your loan amount. And because it's such a long-term loan, when you pay those payments to principal up front, it's saving you so much money down the road. $1,000 could be
so
thousands.
A good example is if my monthly payment is $2,000 a month, just the regular principal and interest. Let's say after I make my payment of $2,000, $1,750 of that was strictly interest, and $250 was principal. And now I decide, okay, well, I just got a bonus at work. I want to put $5,000 down on my loan. If I put that prepayment on top of my mortgage, it only goes towards the principal and does not go towards any interest, correct?
Correct.
And now the next month when that loan readjudicates for the principal interest ratio, which I think it does, it compounds. I think it compounds every month in the U.S. Is that what it does?
No.
For interest?
It's compounded annually.
Okay. All right.
Annual percentage rate.
Adjudication means like them doing that doesn't matter. It's
Adjudication is a word that I don't think you should use as much as you do, but you like it.
I like it. You should adjudicate more in your life.
If I knew what adjudicating was, I probably would. If it sounds like a form of eating, like I'm going to adjudicate this meal. I'm okay with that.
You relate a lot to eating. It
I do.
could if you were to.
Folks, we're down to 190, by the way.
I think you're less than 190. You're 189.
Yeah. No, this morning I was 190 after my workout. 191. Actually.
Wow. Was it after I beat you 4 games straight in squash?
It was after their glass of wine and steak. So.
And 4 games straight in squash. Anyways, I'm a very good squash player.
I have an injured Achilles.
All right. So other questions that would come up, I guess. What's another frequently asked question from an FHA
Frequently
loan?
asked question, FHA loan. I got a fun fact about FHA loans.
Fun fact?
Fun fact.
Is that allowed
when
on
you
Tuesday?
pay, they're allowed every day. I have them every day.
All right.
Different industries. So when you pay that upfront mortgage insurance, it could be a large amount. So you have a $400,000 loan, you're going to be paying, it's just over 1%. So you're over $4,000 in upfront premium.
Mm-hmm.
But if you were to come across some money, or you pay it down below 80%, or just your credit score goes up in, let's say, a year, if you refinance out of that FHA loan into a conventional loan within the first 3 years, you're going to get some of that premium back.
Wow.
Yeah. After 3 years, it's all gone. All hope is gone. You've paid your dues. But before 3 years, you get a prorated amount of that upfront mortgage insurance you paid back.
All right. That's good. I like that.
Yeah.
Cool. All right. So one more question. So I probably have another one, but so the credit score, depending on how high your credit score is, depends on how much risk and how much of a premium you pay. Correct?
Correct. Yeah.
Okay. So what is the threshold for that?
It's not so much a threshold. It's just like if you go get auto insurance, they're going to look at your credit, they're going to look at your driving history. It's many factors that go into it. It's the same thing with mortgage insurance. They're going to look at how much you're putting down. If you're putting 3%, 5%, or 10% down, those are all going to be different amounts of mortgage insurance coverage.
What's your hand there? What's that?
What happened to my hand? I was grilling your corn for dinner on we had a little barbecue on Sunday.
It wasn't my corn. It was everybody else's corn.
Well, I feel like I was turning your corn. Your corn.
That was my specific one?
This was the one I
Specific
gave you. I was just turning it over on the grill and then I just sizzled it.
Oh.
3
That's
people have told
painful.
me, they've told me to put Neosporin on it. It hurts.
Oh, looks like it would hurt.
But I want to see how fast my body can recover with no aid.
All right.
Just in case I ever get stranded, I know what my timelines are like for survival.
Okay, well, that's
So-
good. You're
So
super
far
young,
we're
so
on. This is the 4th day. Should probably be healed
looks
up.
like it just
by the
happened.
end. Yeah.
So back to what we were just talking about. So if I had a really poor credit score, say my credit score is 520, do I get credit? Can I still qualify for FHA?
You can, but you're going to require a more down payment. Believe it or not, you can go all the way to a 500 score
Wow.
with some scenarios,
That's
but
out there?
you're not going to be able to get that and a 3.5% down payment and favorable interest rates. It's going to be an expensive loan. It's possible to get done, but you're going to need, in the area of 10% or more down, and you're going to have
So
to
I wouldn't qualify for a 3% down payment if my credit score was 500.
No.
What if my credit score was 620?
620, you're in the game.
Yeah,
In it to win it.
3%?
In it
Nice.
to win it.
What happens if I was like 680?
680, you're getting warmer.
Warmer.
Yeah, things are looking
Warmer.
up for
I
you.
like warm.
You're gonna get.
I'm
a
warm
good
right now.
deal. 680 would be one of those where you could qualify for a conventional loan on paper, but if your loan to value is real tight or your debt to income ratio is real tight, your insurance is going to be either very expensive or non-existent. It's a
Gotcha.
really hard threshold there where you'd probably just end up sticking FHA because the mortgage insurance, it's offered by another company. It'd just be like going to get car insurance from a company and that company says no, or it's really expensive. 680 on a conventional loan that you're putting 3 or 5% down is going to be very, very difficult. You
So-
want to be above 700 in that regard.
So since my interest rate is since my risk is lower because the government backs it for the lender,
Mm-hmm.
will my interest rate be lower because the risk goes down?
On a FHA loan, 100%.
How much difference are we talking about?
We're talking about, it's so dynamic, but let's say this. Let's say on an FHA loan, a $300,000 loan, you want to go FHA, you could probably get a 2.75 on that FHA loan, given
Okay.
that you have all the right factors, debt to income,
Yep.
credit, all these things that go into it, right? So you get a 2.75 on an FHA loan, you go to the same conventional loan, you're probably going to be like a 3.5.
Okay.
But the difference is you're going to have all that upfront mortgage insurance. You're going to have mortgage insurance for the life of the loan on the FHA side of it, the life that you have the loan. And that insurance is going to be more expensive. So your monthly payment might only be $20 or $30 a month different, and it might actually be more affordable to have the conventional loan, even though it's a higher interest rate, because you're paying all these
Less fees, yeah.
and the upfront mortgage insurance, the monthly mortgage insurance, and that's why it's kind of tricky.
Is there ever an example where it's actually cheaper to do the insurance and to do the FHA instead of having a higher interest rate? Like if there's some type of plan to refinance that property in
Yeah,
3
stepping
years?
stone, and because maybe what happens is a lot of people are consolidating debt, so they're doing a cash out refinance, and they're going to pay off a lot of debt. They have a lot of maybe unsecured debt, installment loans, HELOCs, things like that. When that stuff gets paid off, obviously their credit score is going to go higher.
Mhm.
So they might have a 600 credit score now and have to go into an FHA loan with mortgage insurance for maybe 6 months. And once all that debt gets paid off, the credit score shoots up. They'll refi into their more long-term scenario of a conventional loan without mortgage insurance and at a more favorable rate. So
Okay.
you can use it as a stepping stone. There's a lot of different scenarios, which is why you want to talk to like an experienced, mortgage expert that can consult you and make a plan like that. Otherwise,
Gotcha.
it would just be no, you can't. And you're just going to keep that debt, and you just get stuck in a wheel of never getting it paid off.
That's great. I think our next episode we will talk about how to improve your credit score and how to keep your credit score above a certain number.
I thought we talked about that last time.
I think we have, but I just want to maybe go over it one more time for people.
Okay.
Or you know what, or a better idea, if anybody has any questions or topics that you want covered on our next future podcast.
All three of you watching.
All 3 of you plus our staff watching right now and polka dots over there.
Polka
That would be
dots.
fantastic. So let us know what you would want us to cover, and we would talk about that over the next few pods that we do. But other than that, I think I'm out of questions. Do you have any more questions? Do you have questions?
I've got a lot of questions,
Yeah.
but I guess
The
there's.
beard line looks very questionable.
Is it?
I think we missed some spots this morning.
I didn't
We get,
shave
like
this
longer,
morning. I
longer
didn't shave
hairs
this
down here.
This is Atlantis' doing.
Yeah, we get almost like a bush coming out at the very bottom, and
I'm
then you
trying
got
to go for this
trimmed,
like,
and then you got bush
Italian,
again.
like Italian mobster look.
Dude, look at the
So
Italian
I'm-
mobster that forgot to shave a part of his neck.
When I unbutton, we get like a little flow going out of here, but
Alright.
then just like nothing above that. That's what I'm thinking.
Smell good. It's good. It's distracting.
I smell good. I look good.
Yeah.
I feel good.
Just
I'm
don't do
feeling
this.
really
Don't do this. You might scare somebody. That's all.
good. They're gonna see a bush.
You see a little bush
People
jump
have
out
never
of
seen a bush before. Wait, what were we talking about? Oh man, there was something I wanted to bring up, and I cannot remember what it was.
No? Okay.
No, it's probably good. It's definitely good for you.
Oh, it's about me.
Yeah.
Well, I think we're running out of time anyway, so maybe next time.
I don't like time constraints in my life. Okay. If I want to go free, I want to just be free and just talk. I just want it to flow.
All right. Well, thank you everybody for listening in. And like I said, if you have any other questions or concerns or topics you want us to talk about, please feel free to email us or direct message.
Or any deodorant that prevents your armpits from just flowing like.
Yes, it's very hot in this
Rapids,
exact spot.
Colorado.
Right? We have some. I feel like I'm tanning.
Well, what do you guys think about this? What do you think about this? This is real, by the way. It's a window, and there's people out there.
I can tell you what I think about it. I feel like I'm tanning with my tanning bed with my clothes on.
I feel like I'm on
Maybe a sauna?
an amusement park ride.
A sauna with my clothes on.
Yeah.
Yeah, it's
When
great.
he sees how good he looks in this lighting, thanks to our production crew, he's not going to care about his sweat.
I just have
He's
to-
going to
I
use
know-
these photos for the rest of his life, and his poor grandchildren are going to see how great Papa looked.
Yeah, Papa. I don't have any grandkids.
You're going to have them soon.
Okay. Soon.
Yeah.
That means I'm super old.
Nope.
No? All right.
Doesn't mean that. You
My
know
kids
what
are
it
not
means.
going to be having kids anytime soon. That's for sure.
Yeah, that is true.
But thank you.
Oh, that's how. Yeah, you're right.
That's how it works.
That does mean that you're really old. Because I was just thinking if you had kids again, they would be considered grandkids because of how old you were having them. But that's not the case.
Well,
A
thank you.
grandkid would have to be your kids having kids.
Yeah. My oldest is 10, so
Yeah.
we got to.
He's one of my best friends. He's closer in age
He's closer
to me
in age.
than I am to Greg. So,
All right. Well, that's good.
not
Can
that
we wrap
Greg's
this
that
up,
old.
please?
He's
No?
what, in 30s? You're in your 30s?
No, I'm not. In my 20s.
I've got some beard hair that's in his 30s, but I'm not in my 30s. All right, thanks, guys. Have a great day. Have a great week. If you have any questions, let us know. We'll talk about it. We'll bring it up. And just
That's it.
remember that the tip is referring to the tip of an iceberg, probably the one that took down the Titanic.
Yes, we have a few
We can
concerns or
pick an
questions
iceberg. We're just
about our name.
disruptive, just like that iceberg was to their whole vacation. That's all.
All right. Well, thank you, Garrick, for that explanation, and we'll talk to you guys next week.